With the Strait of Hormuz closing, many small cap oil stocks have rushed up. Of course, we don't know where it's going. This is not financial advice, but today I'm here to look at EON Resources and see what kind of company they are. Currently, they produce 1,000 barrels of oil per day. This isn't insignificant, however, it's still small. Their annual revenue sits about 17 to 20 million a year. I believe the 9 months from September this 2025 or last year 2025 was around 13 million, and the year previous 2024 was around 15 million. Of course, you might look at the diminishing revenue for small cap. It's not best, but if you look at the numbers, if you look at the average oil prices for that period, you'll see that 2024 had a much higher average oil price. Recently, the big news that made headlines for this company is that they went debt free by selling off, I believe, 5% of their overriding royalty interest in the future San Andreas production. This to a private family office. They are an acquisition company at the root of it, and the CEO has come out and said that he does want to acquire more companies. So if we look at dilutions in that case or taking on more debt, the reason why one of the things they've done to make it easier to acquire companies in the future is hedge. It's another big news. With this company is hedge 75% of their oil production in this year 2026 and also all the way down 2027. They took the opportunity during the current oil crisis to hedge around, I believe, in the mid 60s to low 70s. We don't have an exact figure. I've also been waiting for their 10Q, but it hasn't come out yet. I was waiting to see maybe if it came out tonight. It didn't. They filed an extension on the 1st of April this year. So it should come out tomorrow, else they'd be delinquent, I believe. They also have their upcoming meeting on the shareholder meeting on the 20th. So that's something to look forward to. I'm probably going to make another video after that, as I do think this is an interesting company. So yes, they've hedged 75% this year, 75% next year. They are set up to be profitable as long as oil is above 60 in the low 60s. A reason why the stock was trading lower, I believe, in the previous, before the crisis, is that oil was trading below 60 for a while and had only jumped up above 60 around the oil crisis, around the war in Iran. Now, with the massive destruction of oil production in the Middle East and the whole issue around Trump and when the war might be stopped, when it might end, when trade might resume, we're looking at multiple months to even years of high oil prices. And EONR is set to be able to expand their well of production, their barrels of oils productions, and they did come out saying that the recent increase in price sped up their delivery or expected delivery of the wells. And these are horizontal wells. So we could maybe see or envision more than 2,000 by the end of 2026. And these would not be hedged, so an increased return. And when it comes to dilution, as this is a new company, the CEO has come out in an interview, I believe it was on the Marathon Money YouTube channel. You guys can check the video out. I recommend it. It came out about 13 days ago from today, so probably April 2nd or so. And the CEO said that their internal valuation, whatever it means, of the share price is around $2.50, so they wouldn't want to dilute under that price. Of course, it might still happen if they see an opportunity. However, they did say that for any acquisition, they do wish to acquire them at around $60 to $65 in terms of oil valuation. And right now, they're not finding these because everyone wants the war premium. He did say he's following closely the oil crisis, of course, and might reconsider. So I don't know. Maybe they might look at acquiring, taking into account 70s or low 70s oil prices. But all in all, if they can successfully double their oil production by the end of this year and looking at a continuous growth into 2027, 28 until 2030, where in 2031 they would see a reduction in barrel production, but that's for their current investments. Of course, if they acquire more companies, this would increase the number of barrels they may produce. So brings me to valuation. I believe this stock can easily go to $2, even more, $3 if the oil crisis persists by the end of this year. There is a price target of $2 by an analyst. I'm not sure who. So I can see it. Currently, the price is sitting at $0.7 per share, and I will be back after the 10K. But I'm also looking at waiting for the. I'm also waiting for the current Q1 2026 earnings, which should come out in May, soon after the current 10K. So that's all for this video. Thank you.